Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Our objective is to try to help you have a more successful financial retirement. And we really focus on asset management, retirement planning, and tax planning as the kind of three main areas that we delve into. This is a question and answer show. We want to answer your questions. This is live, so you can send them in now to Ask Tom at talkmoneywithtom.com. We'll answer them live on the show here. You can put them into the chat if you'd like. You can also send in the questions during the week, which is mainly the most common way we get the questions. And then we cover questions that came up in our strategy sessions that we think everybody should probably know as far as that goes. And so we're big believers that education, even if you're dealing with an advisor like us, still helps you have a more successful financial retirement. So we've created this Talk Money with Tom channel. We're starting to get closer and closer to 1,000 videos currently on this channel. So you can peruse those at your leisure, but you can also see what's coming out that we're putting out that's new, covering kind of the newest issues that are happening. And so you can subscribe to the channel, hit the bell button, you get notified when we put something out. And if you'd like kind of more customized, answers, you can meet with us. So if you go to our website, there's a link here on the channel. Up in the corner is the book appointment button. Push that button and you can schedule a time to meet with us for 30 minutes, video or phone with Easton and I. So, and, see if we can help you as far as that goes. So really looking forward to being able to see if we can find some things that help you today. Please start sending in your questions. We're ready to basically start and see if we can answer some of those for you too. All right, while we're waiting for the questions to come in, I always like to cover what I saw happening as a summary for this week in the stock market. Obviously, one of the things that's very important about retirement is, how your investments are doing. It's been a tough year altogether. But what I want to cover today, I'm not going to use all the charts I normally use because I want to cover kind of some subjects that I think are interesting and maybe try to keep this as simple as possible. But what's happening right now is you really kind of have two main camps in the stock market. One that believes that the bottom that we hit back in the middle of June is the ultimate bottom, that we are going to rally up from here and eventually hit some new highs and those type of things. And that's the group that's kind of in charge right now. So we've had this nice run up from that bottom point, including this week. And then there's another group that feels that the bottom has not been achieved yet. That we're still going to fall farther, and so they each have their argument. So let me just kind of discuss what each group is looking at and kind of give you some of my opinions on what I'm seeing happening here. So the group that feels that we've already hit the bottom really is looking at the projections for where the Fed funds will go. So the Fed has said in their statement of economic projections that they think they're going to get to 3.8% sometime next year and maybe start lowering rates towards the end of next year. The market believes that they're only going to 3.5% and will actually start lowering rates in February. So think about that. And so the reason the market would be going up so much like it is right now is because if they do start lowering rates in February, that's usually a good thing for the stock market. And the market does look forward, and we're starting to run. And we're having a really heavy run right now with a lot of stocks doing quite well. But if you think about what it will take to get to that path, I believe that path is narrower, still possible. But what would have to happen is kind of one of two situations that I can think of. Number one is inflation would have to fall a lot faster than people expect. So the increases that the Fed has already done to rates would have more impact than it's having now, and we'd see interest rates fall, and then the Fed would start to be able to lower rates to kind of support the slowing economy by February. Okay, so that's one scenario. The second scenario is just that maybe the Federal Reserve kind of chickens out. They continue to raise rates, but the economy starts to soften more than they would expect, and especially because the Fed has a dual mandate of full employment plus low inflation, and maybe unemployment starts to really get higher and higher, and they feel like, hey, even though inflation's at 4% instead of 9% where it is now, we're still going to go ahead and cut rates and those types. So those are kind of the two scenarios. Both are kind of narrow paths just because of the fact that a lot of the inflationary pressure is really coming from outside forces that the Federal Reserve is going to have a hard time dealing with. And this is one of the biggest concerns. And what happens is, so the price of oil and natural gas and things that are kind of being buffeted around by what's happening in Ukraine, the supply chain issues that we're having trouble with in terms of getting enough supply that's coming out of, the lockdowns that are happening in China. The Federal Reserve cannot control supply. I mean, one of the things I keep reading about is how much airline tickets are going up, how many flights are struggling and those types of things. And one of the main things is getting pilots. Well, if they raise rates, that's not going to get more pilots, right? So these are the things that are going to be a little bit uncontrollable, but the Fed has seemed to be very focused on getting back down to 2%. And so the group that feels that we might hit a lower low than we hit in mid-June really feels like the Federal Reserve is going to have to raise rates even more than they say, and that they'll, in so doing, create this scenario where the economy really struggles, and enough to really impact earnings, which will ultimately impact the stock market to the downside. And their arguments are plenty, actually, and I think this path is a little bit wider. For example, as you raise rates, oftentimes, globally, all of a sudden the U.S. is paying pretty decent rates on its treasuries. People start buying treasuries because we're a safe haven, and other countries are raising rates, kicking us into, a possible global recession. And so people look to the U.S. and they start funneling money to the U.S. and then we're raising rates some more. More money comes into the U.S. and what happens is the dollar goes higher and higher and higher. And so we're hitting some really good highs right now on the dollar, and the projections are that it could go a lot higher. That can take a big chunk out of these big companies. The S&P 500 sells 40% of its products internationally. So the more the dollar goes up, the more expensive their products get, the less they tend to sell, the more they can cut into kind of their profit earnings. And then, of course, around the world, the dollar is the major currency, and it causes all kinds of problems when the dollar gets really high. Emerging markets often have debt that's denominated in dollars, and so they're taking their currency, whatever their currency is, converting it to dollars and paying off this debt. And that can be way more expensive as the dollar gets higher and higher versus their currency. And so you've got all of these different things that are happening that are kind of this outside arena that the market the people that are afraid the market's going to go lower. This is what they're afraid of, that the Federal Reserve is going to have to raise rates more, and that they're going to keep raising rates in order to try to bring down inflation. And in so doing, they're going to create this problem in the economy. So this is the battle. Right now, the group that is winning is the group that feels that the low was already established in June. The market is going up. We're getting through some resistance levels. We're about to hit another resistance level, a fairly big one, right now. We're getting there right now. So next week might be really important. Do we just fade off of that and come back down? Is this just one of those rallies that happened? I mean, one of the things you have to remember is that the motion of this market is a lot like what happened in 2000 and 2008. It's not this V recovery thing like we saw 220, it dropped direct down and right back up. Remember that in 2020, we ended up with the Fed lowering rates, buying bonds, all kinds of stimulus coming out from Congress. None of that is happening here. And so we're getting these rolling downturns. And I very specifically remember in 2008 thinking, wow, this is such a great run-up. We're going to end up with this, it's over, right? And then it wouldn't be over. And it really kind of wears you out on the downside. So that's what we got to watch out for here, because one of the reasons that we could be running up is just because if you look at the surveys, the hedge fund managers have less exposure to stock than they had since 2008, and they have more short interest than they had since 2008, which means that they're shorting the market and they're out of it on the long side. What happens when the market starts to come back up is they have to cover these shorts by buying back those stocks. So these fund managers who don't really want to have stock, and that's why they're shorting, are actually having to buy stock, and they're driving the price up and up and up. And we've gone through this kind of hole in the resistance that we see, and we're flying through that right now. So, we'll have to see how this plays out, because you can get a scenario where things get so good that the fund managers and hedge funds, they have to jump back in and start buying stocks, not just from a short covering standpoint, but buying stocks because they feel like, they're missing out. They are being compared to these indexes, but you're going to have a period of time where they're willing to wait, because we all can see what happened in 2000 with these fake runs. We can all see what happened in 2008 with these fake runs. But because this has been so strong and because the market has broken through some resistance levels, in our portfolios, we have eliminated the inverse positions. We had roughly 5% overall of our portfolios in inverse position, and we took that out today, actually. We're still keeping our treasury bill position, which is quite large, and that came from stock sales that we did kind of end of June. And really, I think right now you just want to be very cautious and incremental in your changes that you're doing. I still want to have a parachute with these T-bill ETFs in case the market does, follow what I think is probably the wider path, which is to get to a new low. But we'll reduce those more and more if the market takes the narrow path and just keeps on blasting through all these resistance levels and keeps on going. I think being cautious here is wise with all the different signs that are happening. And so, that's what we're doing at this point in time. So that's what I see. Battle between these two groups. Those are the arguments that are being made for each one. It's very fascinating to see how this will play out. And the Federal Reserve is in the middle of all of this, and trying to figure out what they're doing is a big issue with what we're doing right now. And so it's very, very fascinating. So keep going with everything. We're still making money right now, just because we still have exposure to the stock market, so that's good. And we'll see how this plays out. Really, I think the next week or two will tell us a lot of what's going to happen also. So look forward to that. So thank you for listening for this week's summary. Look forward to talking to you next week. All right, let's get into our first question. What do we have for a question today?
When are annuities appropriate, and what are some of the good use cases for them?
Okay, so an annuity is basically an investment with an insurance company. You put the money in, it grows tax deferred, so you don't have to pay any taxes. There's fixed annuities, there's variable annuities. Fixed, you're just getting an interest rate, that's fixed by the company, can change, but the principal can't drop. Usually the rates are fairly low because of that, but often better than a CD, for example. Mm-hmm. Sometimes you're locked in for a period of time. Sometimes they have a penalty for 5, 7, 10, 20 years. That depends on the annuity. And please keep in mind that annuities are all specific by contract. So you can go to one company, they can have 100 different contracts, literally. Some of them are older and some of them are newer. They can all be different. So I'm generalizing some of the big things. The variable annuity is where you'd be able to buy some stock and bond, usually mutual funds inside of that. You can make changes usually for no cost, and there's no tax because it's tax deferred. You only pay tax when you pull money out of those. Okay, so going way back, annuities were, I think, quite useful because it was one of the places you could go and set up a portfolio of all of these different fund families. And you could have a little of this fund family, a little of that one, and kind of best of breed. And I know that sounds really funny, but we couldn't do that before. We do that now every day, all the time with TD Ameritrade or whatever. And so the market has kind of shifted and made things, I think, better outside the annuities now. And so there aren't as many use cases for an annuity here, in my personal opinion, as there used to be. But there are two big ones that I think do make some sense. First of all, let's say you have an annuity from some time past and it's made a lot of money and you put in something and it's worth more. And let's say it's not in an IRA or something where you could just roll it out. It's in what we call non-qualified annuity. It just means that if you did take it out, you'd have to pay the taxes on that gain. And the gain's fairly high. But the best use case might be to move it to a cheaper annuity, a more current annuity, a no-load annuity, or one that has more investment options or more cheaper investment options. And you just kind of keep that by rolling it over through a 1035, I believe they call it, exchange. You don't have any taxes on that exchange. You can kind of roll it from one annuity to another. And so that is a use case for an annuity, is to constantly kind of look at, if you're going to keep it in there, what's better? Now, what annuities are out there, especially if you can get into one that doesn't have any penalties and costs less, and then you can go to another annuity that doesn't have any penalties and costs even less than that. That's what's happening right now. There's kind of a battle down to that level. They're getting more efficient as far as that goes. Mainly because they're having to compete with the the new portfolios that we can create, right? TD Ameritrade. The other use case scenario that might make some sense to me is just to use it as a pension. So what they call a single premium deferred annuity is where you would take the money and basically you give it to the insurance company and they give you a payment for life or for you, joint life for you and your spouse, or you can do joint life with 10 years certain. There's all these options that you can pick. But the idea would be that you're generating an income, sort of like a pension, that isn't reliant upon the stock and bond market. It's sort of like Social Security too, right? So you got Social Security. A long time ago, everybody had, not everybody, but a lot of people had Social Security and pension. And now pensions have kind of dissipated and there's few of them left. And so you create your own pension. You take some of the money and you put it in a single premium and you get a pension payment. No matter what happens to the stock and bond market, to a large degree, you're pretty you're insulated from that. And at least maybe a portion of the assets going towards this pension payout, you could make an argument for as far as that goes. So, I mean, what do you think, Ethan?
Pension, or the idea of annuity is great in the sense that you get a stream of income. One issue is, does that income, do you have a rider that has inflation protection? Because a lot of times if you have just a regular annuity, you get locked into one income. And if that's your sole source of income, and it's not keeping up with inflation, your purchasing power as you get older goes down, which could be an issue. But I think having like a balance, I want some that's not market dependent income. So you have maybe a portion of your portfolio in an annuity that's coming into your account on a monthly basis, and mixed with like another portfolio actually in the market, a brokerage account or your IRA, where you kind of can keep up with inflation and it outperforms that. That'd be a good way, that flexibility of having both.
Yeah, I think that's important because a lot of times I see people get carried away one way or another. And so if you put everything in an annuity, I think that would be a mistake because you don't have liquidity. You basically, especially a single premium deferred annuity where you're annuitizing it, essentially what's happening is that money's now gone. Mm-hmm. You have no access to it, but you get this income every month. And so that's fine for a portion, but if you did that with everything, that would be probably not what I'd recommend. So I do like it in that sense, right? I mean, because that's one of the problems. If you're living off the stock and bond market solely and you have everything there, it does create issues for, the ups and downs like what we're having right now. And so having some set income coming in, especially if you keep it small enough that it's not really messing up your tax planning capabilities, right? You get a big annuity coming in, all of a sudden you got your, R&Ds coming, your required minimum distributions at 72, and you got all this taxable income. So, that's another aspect that you have to look at is kind of the long-term payout of that because it is, partially taxable. Some of that's going to be return of principal. It depends on where you had it. If it was they're allowing annuities now in 401ks. That's new. And basically that I guess they're going to, right? They're working on that. It hasn't got through yet, but we'll let you know. But that's big deal right now is they're trying to push this through. And the idea is to let people have some form of a pension instead of having to live off of stocks and bonds, which can be, a lot more difficult.
And it's a lot easier to plan. If I'm planning with an annuity and I know I'm getting $5,000 a month, it's a lot easier to plan out your future because the nice thing is it's very hard to outlive, or I think with most annuities, you can't outlive the payment cycle based on how the contract's set up. And
All right. Go ahead.
And so, like, being able to, that's one of the issues with, as people are getting older and older, is they're living longer. And running out of money is a lot easier when you live long. Okay,
so here's a question. How much would you allocate to that area, to a single premium fixed annuity? If on a percentage basis, what percent goes there compared to the other areas?
That's hard. I think you could say 15 to 20% would be okay. You'd have that stream of income, and then the other percentage, that would be your safety net. I have this money and Social Security coming in, and that should cover most of my basic needs, and then I have this kind of market-based portfolio to cover the rest.
Yeah. And this is one of the ironies of it. I'd probably say 10 to 15%, just because you lost the liquidity of that money, and I believe the stock and bond market wins in the end. Matter of fact, that's where the insurance companies are putting the money.
Mm-hmm.
And so here's the issue. In order for that to work, you have to have, I mean, if you have $100,000, putting $10,000 to $15,000 into a single premium annuity, it's just not going to make enough difference.
Yeah.
You know what I'm saying? So you have to have more money, right? And then when you have more and more money, so really to make a difference, okay, now I have $5 million. Now I can put $500,000 in there. I don't know, but if you've got $5 million and you run the numbers, you might be so far insulated from any stock or bonds. And so that's the weird thing about this. It's why I oftentimes don't see this being used, because you need enough money, because it does make sense for a smaller amount, even for the 5 million person. That's not a terrible concept. But it just, that person probably only, I'll make this up, let's say that person really only needs 3 million anyway. So yeah, the market can drop them back to 3 million. That's a pretty big hammer on that overall thing. And so that's one of the very fascinating things about that whole single premium arena is you need money to make it work, because you shouldn't put too much in there as a percentage basis. If you don't have a lot, even at $1 million, you're going to put 100,000 in there. It probably makes some difference, but it's not, because if you do 100,000 to an insurance company, you're going to get, I don't know, single premium, 6,000 a year, and the markets all fall apart, and you've got your other 900,000 in the market. Is that 6,000 going to save you $500 a month? It helps, but it's not going to save you, right? So that's kind of the weird thing about this. We see this more with pensions, where people do have, and they don't have a choice, and it does save them, but it's a lot of money.
Yeah, and what about this? Like, this is super niche case, but like, let's say I don't care about my estate. I'm not going to have any money to leave over,
right?
And I just want to maximize my spending now. Would there be an idea to use an annuity just to guarantee your income for the rest of your life and then spend aggressively?
Yeah, I suppose so. I still believe, kind of depends on what age you are and what have you, but I still believe that the stock and bond market outperforms that annuity, even on a withdrawal basis. Again, that's where the insurance company is placing the money. But yeah, if you don't have beneficiaries that you care about, because maybe you're doing a 3-4% withdrawal and you could get a 6% single premium annuity, because they're going to keep the money.
Yeah.
And your beneficiary, so they are your beneficiary.
Yeah.
The insurance company's your beneficiary. But, again, maybe there are still some other things you care about in terms of charities or something that you might want to leave for a legacy purpose. But yeah, I think you could make an argument for a higher percentage in something like that, because you're trying to spend it all down and don't care who gets it. All right, what do we have for next question?
So, are there any stocks or ETFs to take advantage of for the Inflation Reduction Bill, or did I miss the chance?
All right, the Inflation Reduction Bill. I love this. It's marketing. Who would vote against the Inflation Reduction Bill, right? I mean, you have to vote for that. So they name these things. And so this is the big bill that we've been hearing about just recently, that Joe Manchin and Chuck Schumer have agreed upon, apparently in the basement of the Capitol or something, on some kind of handshake deal. And it includes a 15% minimum tax, at least in its current framework, right? A 15% minimum tax to corporations, which has already been agreed upon as something that they want to go for with the G20. All the big countries out there are trying to get to this 15% minimum tax. And then there's money that would go towards healthcare, specifically drug cost reductions, and obviously clean energy, which is one of the big ones. And so here are the investment opportunities. As you look at what's happening since that was announced, all the clean energy things popped. I mean, all of them, really hard. And we actually put a little bit of maybe 3% of our overall portfolio towards clean energy today. And there's other things going on with clean energy, and that's why I don't think that you've missed the boat already. First of all, they haven't passed this. We still have to get, that's been, unfortunately, the Senate has been a place where things have gone to die, right? I mean, let's face it, and there's no guarantee that Kristen Sinema is going to, get behind this either. So, not only have you not gotten too far down the road with this, but it might not even happen. But the one thing I do like about clean energy is it's actually been outperforming the market since the invasion of Ukraine, because there is this thought process that one of the replacements for Russian oil, gas, and coal, natural gas and coal, will be clean energy, especially in Europe, right? I don't think clean energy is far enough along to completely replace fossil fuels, but that path just became wider, and there's money maybe being thrown at it even by this bill. So that's the one area that I would look at for that aspect of it. Even if it doesn't pass, I still think there's something to be said there. If it doesn't pass, probably the prices where we're at right now because of that jump would drop back. But again, look 12 months down the road and probably has a good chance still of outperforming the market. That could mean less loss, unfortunately, right, if the market goes down farther. But just because of the dynamics of what have happened there, that's sort of forcing clean energy into the current time frame at a faster rate, right? Solar, wind, geothermal, all these things that'll be much more. I think there'll be a lot more investment across the world in those areas. We're finding out, and that energy, you're reliant upon these other countries to get your energy. In often cases, I know China's really pushing towards being energy independent, and they're making a big push towards clean energy in that regards, right? And because again, China's they're having a conflict with. Earlier, late last year and early this year with Australia about coal, right? And so, if they get their own energy, they don't have to have those conflicts. And obviously, Europe really, really could have used a scenario where they had their own energy. If Europe was energy independent, Russia would be really, really getting hammered here with those sanctions. But ironically, the sanctions are making Russia richer, at least on the sale of oil, because it's driven up the price of all these natural, all these energy sources that they're selling. So I don't think it's too late. I think it's actually maybe too early. But the one area that we're looking at and have some interest in is in that clean energy area.
Yeah, and the thing about clean energy, as technology gets better and better, the cost to produce gets down and down. And once it starts at, I think it's starting to get to a point where it can compete on some of the more expensive resource-intensive energy productions.
Yeah.
And so there's also the issue that they have to still solve is where do we store this energy when there's a low period in production?
It's two issues, storage and transmission. So storage, they're working on these big battery banks and what have you. We've seen that. And there's other things. There's some interesting storage arenas that are happening. There's one where I saw where they use solar to basically take oxygen and liquefy it, and then they let it back out and drive these turbines and what have you. And there's some really interesting things happening there. But transmission is also a problem. So if you're a country like the U.S., you have wind in one part of the country, you might put a lot of solar, windmills there, but they need, energy across the country. And the way that they do energy now is sort of regional, right? Because you can ship coal and natural gas and or pipeline it or whatever. You have to have a way to transmit it, and we don't have an infrastructure that will say, okay, I can put windmills in Washington State, for example. I'm making this up, but to say they have high wind, and still have that energy get to someplace farther away, even like Florida if they needed it. Maybe Florida, Arizona have sun, and that has to go up into Michigan, that kind of thing. So. Transmission is an issue, and this is why I think it's hard for clean energy to completely, eradicate. Also, the efficiency of clean energy versus the efficiency of the way that they can burn natural gas and oil and coal. Coal's less efficient, but nonetheless, those other two, and that's getting better and better, right? They're getting better and better at getting the energy out of solar panels and those type of things. But I remember an article a long time ago when they were talking about ethanol possibly replacing oil because you could make gas out of ethanol, and that kind of thing. And then somebody did the calculation and figured out they'd have to basically blanket the earth in corn. Every ounce of the earth would be covered in corn. And so it's somewhat similar to that right now. Is there enough room for the solar panels in Europe, let's say, if they want to completely get off of this? And so that's why there's this potential gap right here. But there will be a tremendous amount of money probably going towards, at least as an add-on. So, hey, we're going to cut off from the gas from Russia. So we're going to get liquefied natural gas, which can be shipped. There's piped gas, and there's LNG, liquefied natural gas, which gets shipped. And so that's one way you get around it, right? And so they have to have special ports, and there's only so much that can get shipped. And then maybe clean energy is a part. So clean energy is going to be a part of the answer, not the whole answer. But all it needs to be is a part for that investment to do better, especially since you're seeing, a lot of these clean energy pieces, ETFs, for example, are down, 40 to 80% from their highs that were established in February 2021. So ironically, they're still not cheap because these companies still don't have massive earnings. These aren't Apple or Amazon and Google. These are companies that I know, but you probably haven't heard of before. So, but they're a lot cheaper. And so there's some potential there, especially if money does start to be thrown their way. So I think it's an interesting question.
So what do you think about semiconductors with the new bill that's been passed the, I guess, Congress now and has gone to the president to be signed? So it's essentially, they're giving money for semiconductor manufacturing to the U.S. and some tax credits.
Yeah. So I guess one of the things I look at is what did the market think, right? So this thing passed the Senate, it passed the House, and now it's sitting in the White House. I think it's going to get signed Monday, was what they were saying, which is great. So it's very developed bill. It looks like it'll go through. The idea is that a lot of our chips are being manufactured in places like Taiwan. And what happens if that stops? What happens if China invades Taiwan, cuts off that chip production? We would be in trouble. It's amazing how many things are being made, the amount of revenue that would be lost because people couldn't make, cars and all these different things. And so having chip production here in the U.S., I think is, critical. And unfortunately, the chip production here in the U.S. is a lot more expensive, so that's where the subsidies come in. You try to make that work. But I will say, lots of articles talking about the size of this. It took 2 years to get this through. About $52 billion of this bill is going to go towards these subsidies and what have you, which is really a lot of money, but it's kind of a drop in the bucket when you look at the overall size of the chip, industry and how much it costs to build one of these and operate one of these foundries that are happening. So I did not see the stock market embrace the passing of this bill, which makes me wonder, is it that great, as far as that goes, from an investment standpoint? I think it's great from a national security standpoint. I think it's a good bill. I'm happy about it. But, the market didn't go nuts. We didn't see huge run-ups. There are some of these companies like NVIDIA and AMD that don't make chips here. They're basically designers, and they send those off. They would benefit indirectly. If we had more plants here, they'd be able to have more options. If Taiwan, for example, did get cut off, they'd have more options here. That'd be good for NVIDIA and AMD. But it's really better for the Intels, Texas Instruments, and these companies that are actually making these, chips right now. And even the Taiwan Semiconductor Company, which is going to be putting in a plant here, was behind this bill. $100 million was spent, according to the article I just read in Bloomberg, by semiconductor companies over the last 2 years lobbying this $52 billion that's coming back their way. So it's kind of
good return on money there.
It was a good return, but you can tell the market isn't that enthused about it, to be honest. Maybe it'll play out in over time, but
yeah, it takes a while for these fabs to come online. It's not a quick solution. It's going to take years for them to build out these production centers, and so these companies aren't going to realize this revenue for a while.
Yeah, exactly. Yeah, so I think it's good, but I don't know what the investment opportunity is there per se.
So, your next question is, what is a target date fund?
Yeah. Keep this one pretty simple. Actually, a target date fund is a mixture that is put together by a company. Vanguard is a huge target date fund provider. They'll have U.S. and international stock, U.S. and international bonds. Those are kind of the four big areas that you run into all the time. They'll break that down into some sub-segments, but there's usually a date on them. 2030, 2035, 2040, usually every 5 years. And what happens is the longer the date, the idea is that retirement is farther off, the more stock you should have right now. And then what they do is they reduce the stock exposure as that person gets closer and closer to retirement. It's not a bad solution, especially if you had to pick one thing. They can often be, pretty inexpensive, and you'll see them just littered inside these 401ks. There's a lot more of those options as far as that goes. So that's what it is. I think there's some pros and cons. They've had a lot of international exposure recently, which hasn't worked out very well. So there's not a lot of flexibility as far as that goes. They stick to these kind of overall allocation models, but that's what they are.
Yeah, they're great because they take that thought process out of you. How to allocate your risk, how to allocate your portfolio. They do it for you, and they're very simple. They're very efficient, and so they're a great asset to people that are just starting out in the investment world.
Yeah, and just keep in mind you can increase your risk or decrease your risk by picking different dates. Pick shorter dates; they're closer. You're going to get a less risky portfolio than a longer one, so you have a little bit of flexibility what you could do with that. But that's the idea.
So, what happens to a 529 if it's unused, and how can I use the money if I don't use it for a qualified distribution?
All right, so 529 is considered a college savings plan, although you can now use it for schools, private schools below, college, high school, middle school, elementary school, that kind of thing. And qualified expense would mean, something that you're using towards that school, whether it's tuition, and they've broadened that, to include laptops and some of the other things that you might need to pay for. And it grows tax-free. So you put the money in. In some states, you get a write-off for that money. It depends. Here in California, we do not. You can use any state. Although if you're getting a write-off, you probably want to use that state's because you're getting a write-off. Here in California, it doesn't matter. You might as well use any one of them. Just pick the best. It could be New York or Utah or whatever. So that grows tax-free. And then, maybe you are the owner, and one of your children or grandchildren or whoever you're doing this for is the person that's going to be who they look at. Are they in college and pay for those expenses? You can move who it's pointing to. So if I have it pointed to one of my children, doesn't go to college, I can point it to my other child who is going to college, right? I can then continue to use it if it's not used for other family members. There's a limit to how far I can go in the family tree, which I don't remember off the top of my head, but I can go to my grandchildren, certainly, and I could give money to my grandchildren. And so we have seen a fair amount of these that are overfunded. The market's grown, they grew tax-free, and the expenses weren't as high as expected for college for a variety of reasons. And so what happens? You have a $300,000 in a 529. I've already put my kids through school, and maybe my grandkids through school. And so these can be transferred on to a different custodian when you pass away, as long as you have a successor custodian, and which is what you want to do in the setup of that 529. So theoretically, you could make one of your kids, now that's an adult, the successor custodian, and they could use it for their kids or their grandkids, and so you can have this kind of generational thing. And we were looking this up earlier. There is a limit, like it depends on the state, for how much you can have in those before you can't contribute anymore. So it's $529,000, right?
Yeah, 520. With the 529 in California, it's 529,000, which is super simple to remember. But each state has its own kind of aggregate limit. So I think the top ones are at 550, but they can drop down into the 300s or 200,000s. Right. And so it's really based on what they could deem as education in their area would cost. Would be the aggregate limit they would hit. So we were talking about this, and there you can make these kind of generational, maybe your great-great-grandkids are benefiting from this overabundance of money that you put into this 529. Although when it goes from one generation to another,
it is considered a gift, and if it's over the amount that you're allowed to gift, it comes off of your estate tax exclusion, which right now is very high, it's 11 million each, but that might go down coming up in 2025 to who knows, but maybe 5.5 million.
Yeah.
It's actually higher than 11 now. They've indexed it. It's 12 something, but
Yeah.
nonetheless, it still might be worth it, to have, because you're going to have that asset anyway. That's going to be part of your estate. So then it just becomes part of your estate again as you go through. If you have a big estate, that could be an issue. There's some other areas. So if you have 30 million and you're allowed 11 million each, the taxes start off at 43% for estate taxes. So,
Yeah.
But for most people, don't have estates quite that large. It is kind of an interesting thought process, this tax-free growth for education. Obviously, you have no guarantees that it's not a trust, that their child or grandchild wouldn't just cash it out. There's a 10% penalty to cash it out.
Yeah. So on the earnings, there's on the earnings you're taxed on as ordinary income plus a 10% penalty. So your contributions are tax free when you get returned, but anything above that is kind of taxed.
Yeah. So, that's what happens. You can use it. You can point it to other people in your family tree where it's allowed and try to use it up that way. You can use it for yourself, apparently, right? You decide to go back to school or something. Or transfer it on to that next generation, deal with that kind of generational, hit to your estate as far as that goes. But again, if you don't have a big estate, that might not matter. And then, maybe that's something that just continues to go down and fund, sort of a legacy. It is tax-free, which is pretty phenomenal if the money's pulled out for these qualified expenses. So it's an interesting thought as far as that goes. We haven't seen anybody do this. We have clients that have overabundance of money in 529s, but it wasn't set up with the thought process of, this is going to be generational type thing. It just, they put too much in and it grew too much, and then the costs weren't as high as they thought. They got scholarships or went to a cheaper college or whatever it was.
Yeah, and the nice thing is if you get scholarships, you can reimburse yourself in theory and consider it as a qualified distribution.
Yeah.
So say your child gets a $40,000 scholarship. You could take $40,000 out of your 529 and it would be still considered a qualified distribution.
Yeah.
And so there's ways that if someone qualifies for aid, you can get money back still.
Yeah. Yep. That's a good point, actually. So good. Okay. We're pretty much at the end here. So we'll go ahead and wrap this up. I want to thank everybody so much for coming today. Really enjoyed the show. Hope everybody got something out of this. Continue to join us. We'll be back next Friday. Obviously, we put out, the questions you can send in at any time with the Talk Money with Tom, email address that you see there on the screen. But we also put out new content all week long. I do a summary each day of what I saw happening with the market. So you can go check those out on our channel. It's usually best to subscribe so you just get a little email notice whenever I put one of those on. If you want to keep up with, what we see, it's a fairly efficient way of finding out what happened that day with the market. And then, obviously, the next thing would be set up an appointment if you want. Come and visit us on the phone or on video, 30 minutes, see, if we can help you with something and, give us some background on what you're looking for and maybe answer some questions more directly as far as that goes. So look forward to the next show, and I look forward to seeing you then. Thank you for coming today.